right, hello, welcome to another session at the Digital Container Summit. My name is Alexa. I'm the marketing manager at Container Exchange, and I am here with Eric Johnson, the senior technology editor at the JOC, and he will be giving an overview of the container shipping market. But first, a little bit about Eric. Since 2003, he's led coverage and analysis of technology's impact on global logistics and trade. He regularly reports on how shippers, carriers across all modes, and logistics companies use software, as well as new concepts impacting core freight transportation processes like procurement, execution, visibility, and payment. Mr. Johnson is a regular presenter and moderator at industry events like TPM and TechLog, you may know, and webinars as well. And now he's here at the Digital Container Summit. So Eric, to you.
Thanks so much, Alexa. Appreciate it, and appreciate the invite from folks at Container Exchange as well. I'm really glad to be here with you all today to present on kind of how IHS Markit and the Journal of Commerce see the container shipping market, and definitely welcome any questions you may have. I'll try to answer as many of those as I can. So let me just dive straight into the presentation. So this is a chart that is pretty widely available, depending on the source you look for, but and should be familiar to most folks out there. I think the interesting thing about this chart in 2020 is, first of all, from a historical context, we're looking at now kind of a top 12 that's really separated themselves from the rest of the pack, and you can even condense or segment that into kind of the big four, the next three, and then the last five in the top 12. Historically, we used to think of a global top 20, then that sort of condensed down to 15. And now we're really looking at top 12, and really those top seven have a really dominant share of the market. Even the top four, just in terms of capacity available today, now have more than 60% of the market. And we'll get later in the presentation, I'll get more into some of the dynamics around what has caused that shift and consolidation at the top. So just to layer on top of that current capacity, what vessel capacity is on order, you can see that a lot of the big lines, the top three, have very little capacity on order relative to their existing fleets. There's really only two carriers out of the top 12 that have any sort of significant capacity on order, that being CMA, CGM, and Evergreen. This is a real big change, a sort of, not to use an overused phrase, but a sea change in terms of capacity as it relates to current capacity that's deployed, or ordered capacity relative to capacity that's on the water today. And this next chart sort of shows that in more stark contrast. So what you see here is total capacity that's on the water today, total that's on order are those little gray bars next to the taller green bars. And then that blue trend line is showing the percentage of capacity ordered relative to current capacity. And what we see is post the financial crisis, that percentage has just nosedived in a way that it never did historically. Alexa mentioned that I've been covering this space since 2003. The going wisdom back then in 2003 was all the way through probably to 2010 was whenever ordered capacity fell below the 20% ratio to compared to current capacity, that always triggered more orders. That was sort of the received wisdom that the industry was going to start to order again. And what we've seen over the last decade plus is a trend very much against that, and to the point now where we're less than 10% of current capacity is on order. So it's a big change in terms of the makeup and structure of the market. And the question is sort of what's causing that, or is that it's a sort of chicken and egg question. Is what's happened over the last decade causing that, or is what's happened over the last decade caused by that. So I wanted to put this slide up because if you look at the top right, this slide is dated for mid-March, and this is a slide that we presented at a virtual version of TPM earlier this year. We had to cancel TPM due to COVID. We did a virtual version a couple weeks later, and this was a slide that we presented as of mid-March. And take a look at those charts on those bar charts on the far right. These were our projections going into 2020 pre-COVID. We were looking at an almost 3% growth in global container volume this year. By mid-March, the forecast had sort of split into two theoretical ideas of where the volume increases would go globally, with a low end of 1% and a high end of 2.1%. Now, I don't have a chart to show how much things have changed in 6 months, but I'm just going to mention it. Basically, our internal IHS market forecasts are now showing a 8.9% decline in global container volume projected for 2020. Obviously, things have changed drastically in 6 months. To put that in context, relative to the last crisis, container volume fell 10% in 2009 as a result of the financial crisis. It rebounded to 14% in 2010. We all remember those days. We are similarly, as of now, projecting 21 and 22 to be at around 6% growth each of the next 2 years. But obviously, the fluidity of the situation, how quickly things have changed in terms of volume, is really interesting and historical to look at. And it's really, I'm going to go in a little bit later into how much has changed since the last crisis in terms of how carriers are managing this crisis and how well they've navigated it. But the real gist of this particular slide is to show that even as recently as March, we were thinking somewhere in the 1.5% growth projection. And 6 months later, we're now talking about a 10% reverse from that projection. So really fluid situation. So I wanted to put this slide up also to sort of double down on this, on how much the market has changed. So we sort of track on the eastbound Trans-Pacific, so Asia to North America. We're looking at how much volume is being booked direct with carriers versus how much is moving on NVO contracts or with NVOs. And you can see in the first 5 months of 2020 on the far right, that NVOs actually got a pretty nice uptick of market share, about a 7% growth over what they had at the same period of 2019. So 7%, pretty significant for, as you can see, this is a pretty steady kind of trend line. Over time, it's trended definitely toward more NVO share, which is interesting in the TP since you find a lot more shippers wanting to do as much direct with carriers as they possibly can. So we see that long-term trend of kind of going more with NVOs, but it's been a gradual trend. So a 3%, a 7% uptick in terms of market share is significant. It's even more significant when you layer in the fact that volumes are way down this year. So you have a market share increase in a declining overall market. So it's very interesting to see that shippers are gravitating toward NVOs to get capacity in a very, dynamic market where we've seen kind of freight rates really spiral up and people kind of scrambling for capacity. So let me shift gears a little bit and kind of get into the gist of kind of what I'm going to be exploring for the rest of my presentation today. This for some reason in my head, this particular quote sticks out like a sore thumb. This was at TPM in the fall of TPM Asia, I should say, the event we hold in Shenzhen every year in the fall. So this is fall of 2010. Ikmeng Ng, who was then president of APL, did a presentation, and he said, to answer a question with this quote, "I know what the cost is to move every box, all the fixed costs and all the variable costs. We're very clear on this." And I remember that quote. because he said this in 2010, which, as we all remember, was a very good year for carriers coming off a very bad year for carriers. And APL had a net profit in 2010 of 461 million. Very solid year. But then the bottom dropped out. And I hope you can read all of these individual things. These are all direct from APL's kind of, investor relations page. So you can go see these for yourselves. But essentially, over the next 5 years, APL had $1.4 billion of net losses. So go cast your mind back to that quote, fall of 2010. APL's president says they know exactly what their costs are to move every box. And then over the next 5 years, they proceed to lose $1.4 billion net losses. So what does that say? And I'm not at all meaning to pick on APL. They're sort of a victim of their own of transparency. They used to put out very clear, very transparent financial reports. So it's sort of easy to pick on them in this case. But obviously there were other carriers, if not most of them, were sort of struggling under the same scenario. But what does this tell us about what happened between the financial crisis and the middle of the last decade? Well, clearly, I think what we can see from that vessel order situation, which peaked at around 50% just before the financial crisis, 50% of current capacity on order. Too much capital was being spent on vessels. We've all read a million stories about keeping up with the Joneses, being inclined to order capacity to make sure that you're not losing out on slot cost optimization and you're running, the most efficient vessels, the biggest vessels that you can to reduce the economy or get economy of scale. But too much was being spent industry-wide and individually by the lines. And not enough was being spent on technology. And obviously this is something I focus on a lot. I can remember writing multiple columns sort of theorizing, what if a container line took all of the money that it spent on a single string of vessels that it had planned between Asia, Europe. Generally, they obviously go into Asia, Europe first, and then sort of cycle into the TP when the TP had built enough port capacity to handle larger ships. But what if they took one string of vessels that they ordered and had planned for an Asia, Europe string and didn't make that order and spent all that money on technology? Well, basically, essentially, what we've seen over the last few years is that come to fruition. You've seen them sort of transition to focusing on what they can do technologically, internally, and customer-facing, and not buy vessels that were sort of undercutting the market in themselves. I think there was also a recognition, slow recognition, but it's there of, the big ship burden was pushed, too much of it was pushed to other parties in the industry. And not enough focus kind of on viewing themselves as more than just vessel operators between ports, and start to look at themselves more as kind of supply chain partners. And we're seeing the kind of manifestation of that through some of the lines looking at themselves as more end-to-end supply chain management providers, and less as just sort of pure vessel operators. It all came to a head in the middle of the last decade. It seems crazy to think how long ago the Hanjin bankruptcy was, because it seems like yesterday in some respect, but it was 4 years ago now. We saw a lot of consolidation, a lot of acquisitions and mergers, and essentially it just led to consolidation, which is where we're at right now. And this is sort of a visual representation of that capacity consolidation. This is dating back almost 25 years, this presentation, this slide. And the takeaway, look at that top 5 market share. I actually think this slide's also from March. We haven't had any more acquisitions since then, but if you go by the most current capacity numbers, actually the top 5 has more than 67% of the capacity. So basically 2/3 of global capacity is now in the hands of 5 lines. There's no doubt that it is changed, kind of the scenario in terms of how carriers can control capacity and manage that capacity. So to sort of double down on this topic, the buzzword, and I'm sure this has been discussed earlier today by some speakers who have also talked about, kind of where the container and shipping industry is right now. But the buzzword today is really capacity management. I think it comes up in almost every conversation we have with shippers. It comes up on every earnings call that the publicly traded carriers make. They've all talked about how they're able to throttle capacity in a way that they never have before. And the end result is that container lines in 2020, there's a lot of acrimony, I would say maybe even antipathy toward the carriers right now. But, we sort of step back and look at this and say, well, actually carriers are starting to act like normal businesses now. They're starting to say that profitability is important, shareholder value is important. The customer service is certainly important, but customer service can't come at the expense of running profitable businesses. So that's, big change. And the question is, again, was this a result of the consolidation, or did the consolidation come about because the industry was already trended this way? They've used their ability to blank sailings, and I have a slide coming up in a sec that kind of highlights this visually, but to really throttle back capacity in a way that they hadn't other than 2010, which really angered the industry in terms of how they managed capacity. But they went away from that very quickly. From the first half of 2010, they managed capacity and then sort of got back into their old habits. And this was underscored just a couple of weeks ago by Søren Skou, the CEO of Maersk Line, who said, in 2010, everybody was looking, including Maersk, was looking to fill ships. That was sort of the operating strategy, was to fill ships at all costs, to keep the network kind of full, or to optimize what the network as it was built, instead of looking at their businesses like a FedEx or UPS would, which is you throttle the network based on what the demand is. So that's clearly a big change. Shippers are telling us that carriers are focusing on profitability in their discussions. And this goes beyond just kind of annual contract negotiations, but kind of, shippers that are negotiating into, toward the end of this year, as well as, shorter term contracts and spot. Carriers are holding a line, and they're saying we'd rather not move the volume at a loss than just move your volume just to fill the ships, or to sort of generate goodwill with customers. That carriers are and we're generalizing obviously here because there's variance between some of the lines in terms of how they handle this, but overall we're seeing carriers just focus a lot more on individual profitability, getting back to what the APL president said, knowing what your costs are, knowing what it costs to serve that customer on a box by box basis, and then actually keeping to that. And really, the uptake for me out of this is, it's really hard to imagine the liner industry managing a crisis, literally a century, once in a century type crisis like we have in the first half of 2020. It's hard to imagine them managing it the way they have this year without this different focus. I mean, again, there's been a lot of anger, I think, and at least frustration about some of the profitability numbers that carriers have announced so far this year. But even in hard times, companies expect to make money. Companies that are providing a service expect to make money, and that's the upshot of this, is that carriers have figured out a way to be profitable in some of the most trying circumstances that they've ever faced, much less in the last 10 to 20 years. And certainly a huge divergence from how they handled the last crisis a decade ago. So here's a visual representation of the blank sailings. Again, this is from March. This is the latest numbers I could pull from, but it just kind of shows the way that carriers could kind of quickly amp up the number of blank sailings that they were able to collectively put in place or take out of the system. And then they've been able to quickly move that capacity back in when demand is there. But they're not rushing excess capacity back in. And that's obviously that's some of the source of frustration from the shipper and NVO side, is that it still feels to them like capacity is being managed too tightly to keep rates up. Again, this is that question of how consolidation has really impacted the industry. But you could, if you look at it from the carrier perspective, they're managing their business in a way that allows them to be profitable. So kind of getting into the area that I focus on most of my day, every day is technology. And I mentioned how I sort of hypothetically said, what if a carrier started focusing on technology instead of hard assets, investing in hard assets? What I would say is, over the last couple years, we have seen an investment in technological capability. And that goes both on the operational back-end side that shippers and NVOs don't necessarily see tangibly, all the way to new customer engagement tools that carriers really never had and never bothered with. I can remember putting together an infographic in mid 2018 that looked at which lines had capability to quote digitally, and I believe at that point it was 2 out of the 12 that I had mentioned earlier had that capability. It's now about half, with from what we are being told that the JOC quickly, most of those lines will be looking to add instant quoting or online quoting or instant kind of procurement capability, at least on the spot rate side, to their platforms. So half of the lines have these digital customer acquisition channels, with more on the way. And I think the interesting thing to think about is it's not just about kind of ease. Some of it is about ease of doing business, to make carriers want to make themselves easier to engage with. For a shipper that moves one box a month to ones that move 10,000 a month, certainly that's there. But I think you have to look below the surface and think about what instant quoting capability enables. And I think some of the lines that have been on the forefront of this, Hapag-Lloyd, Maersk Line, CMA, these were sort of the early entrants into this space of instant quoting. I think they've looked really hard at what the platform businesses have done, which is you can leverage a lot of data from transactional volume, and not just look at, well, I engage with this big volume customer, over a few weeks, once a year, and then it's really only about booking with them and making sure that I'm accepting their bookings. But you're not getting kind of ongoing transactional data from them in the same way that you would with a smaller shipper, who you're finding out what their demand patterns are in more real time. So I think you have to think about the fact that these online quoting tools give carriers a chance to get continuous data, real-time transactional data, and data structured in a way that they want to be able to use it straight away. It doesn't come in 50 different formats. So all of those are incredibly valuable. So that just underscores what I'm talking about. And really, if you think about that from a carrier, from a network planning perspective, from a potentially a vessel ordering strategy down the line, the ability to have more data and more structured data and more real-time data is incredibly important to inform those strategies, whether it's deploying a vessel, a new string, a new expedited service, a guaranteed, kind of capacity offering. All of those things you need to have data to base those decisions on, instead of just kind of, putting your finger in the air and checking which way the wind is blowing. And I'll mention Maersk again. They just announced last month that 41% of their short-term rates are now being transacted via their online quoting tool called Maersk Spot. Their CEO said in the earnings call he expects that to go to 100% at some point. So they expect all of their short-term kind of contracts to move to an online environment. They want that structured data, basically. So some takeaways. What should we think about from all of the information that I just went through? I think clearly container lines are turning away from unconstructive business. They are, if not firing customers, they are working with customers to make sure that they're being compensated or working in a way that helps them, plan and structure their networks in a way that they can be profitable. They have scaled back immensely on vessel ordering, and they're spending a lot more investment into technology, whether that's customer facing or internal kind of operational technology. The 2020 profitability that we've seen so far is really unthinkable in prior cycles relative to the market. I mean, it's really, can you imagine a scenario where global container volume would drop almost 9% and carriers would all be profitable? It seems absolutely absurd to think about. So I think that the end sort of takeaway is carriers are shifting to this dual model. The way I see it is they're not going away from big volume contracts. That's still a core part of how, they base their business in terms of generating, revenue that they can build their business around. It's certain, it's sustainable. So they're not going to go away from, having those close ties and big volume annual contracts with big shippers, but they've also been able to add layer in this ability to get transactional volume and the data that comes with it. And that's been a big kind of technological shift alongside the capacity management things that they've been able to work on over the last decade. So with that, I'm all finished and happy to take any questions that have come in.
All right, Eric, can you hear me?
I can hear you, yeah.
Okay, perfect. So one thing I wanted to draw attention to everyone is that we've got some handouts and offers from the JOC if you're interested. There should be a pop-up on your screen, and you can find that under handouts, and then you have offers and handouts from the JOC. And with that, I will go into the questions. So Harish wanted to know, hey, Eric, what is the trend likely to be post-COVID when the world returns to full production, volumes go up? What is expected to happen to the capacity then?
Yeah, so I'm going to pick up on Q from, I'm definitely not the expert in this, but I queried some of our forecasters and economists internally at IHS Markit. I think I had mentioned, as of now, the forecast is right around 6% increase in global volume in 21 and 22. That's what we're projecting. There's also the caveat that they said, the COVID impacts are going to stretch into, essentially, we're projecting into Q1 of 2022. So, definitely think there's some bounce back and some latent kind of demand that gets answered in 21 and 22. But the situation's so fluid. I think I don't know how much, if you look at forecast versus confidence level in those forecasts, I would suspect that it's a lot less confident than our normal forecast for annual or quarterly would be. But yeah, right now we're expecting definitely some increase, but definitely not the order of that snapback that we saw 2010 after 2009, which was, I think, again, I mentioned it was a 14% bounce back after a 10% drop in 2009.
Right, and that kind of coincides with the next question where Gulnari has asked, could you also share what has changed the most in the way that the industry is now dealing with the crisis compared to the last financial crisis?
Yeah, I think that this is really kind of the chicken and egg question. Is we started to see vessel orders drop right after the last, or right during the financial crisis. So you can't say that that sort of more rational vessel ordering happened as a result of consolidation. I think the consolidation in the middle of the last decade expedited that and kept it low. We didn't see that, that dip in vessel orders bounce back to another round of orders that would have been sort of unhelpful for the carriers in terms of excess capacity. So I think that's the big takeaway is the carriers collectively were able to restrict themselves from ordering capacity they didn't need. And then consolidation started to really occur en masse, and that helped them continue that trend. And then the investment, I will say the investment in technology has helped too. They're just basing their decisions much more on data than ever before.
Okay. Okay, we've got not so much time left, but I think we can combine two questions that are dealing with Maersk. So do you think it is inevitable that all carriers follow suit to Maersk rather than radical spot strategy? And Maersk mentioned they're developing their own TMS. Do you think that other container lines will follow suit?
Yeah, well, now you're getting into what I love to cover. So yeah, I think every line will have an instant quoting, online quoting capability. Soren Skoo said he expects every line to have that within 2 to 3 years. I would suspect that's the very longest threshold for that. It may be as soon as 18 months that they all have some capability. I think there's question about how much each line wants to devote or convert volume into that capability. There's lots of variance between how the carriers look at that and how they want to leverage it. So it will be, as he said, I agree with him. He said it will be table stakes. I actually just had a story up yesterday about this, and I agree with him. In terms of the TMS, it's a good question. I think lines will see whether they get a lot of traction with their TMS that they just launched for sort of small and mid-sized shippers. I don't suspect a lot of carriers are going to throw a lot of money toward developing a TMS right away until they see how Maersk or maybe if another line develops something like that. I think they all have a lot of other things that technology-wise that they could work on that would be immediately more interesting to shippers than a TMS. So I don't suspect everyone will have a TMS. Every container line will have a TMS in the next same time period. I do think they'll all have instant quoting capability though.
Okay. Then we have 2 more questions. I know we're running out of time, but how do you see container production changing off the back of changing shipping line models and capacity?
So the actual production of containers, I'm guessing is what they're asking.
How do you see container production changing?
That's a good question, and I'm not sure I'm the right one to answer that. So I don't want to give information that's uninformed. I don't really track the container production market all that much, so I wouldn't want to speculate on something. But it's a great question, and if someone wants to follow up with me via email, my email is at the beginning of the presentation, and I can certainly try to get an answer to that.
Okay, let me pop up the first slide then, so then we can get an answer for that. Okay, then maybe not container production, but how about bunker prices? Can we answer a question on that? Any insights on bunker prices looking forward and how those prices will affect container rates post-COVID?
Yeah, I think, again, I am certainly not we have a whole energy division that's expert at IHS Markit around that sort of thing. So I wouldn't want to, I'm not the right person to kind of talk about that, but again, I can answer that question. I will say that, again, going back to Soren Skoo on the earnings call a couple of weeks ago, said he expects the lag they were capturing more bunker surcharge than actually because of the lag between those surcharges and how the fuel is actually performing. So I would suspect those rates to be a little bit positively impacted for shippers over the next quarter. That seemed to be what he was intimating, if I understood him correctly.
Okay, great. So that's all the time that we have for today. The next session is already running. So everyone here wanting to learn on a bit about payment collection in this post-COVID world, that session's running now. And thank you so much, Eric, for being here and for sharing the insight to the container shipping market this year.
No, thank you so much, Alexa. Thanks to Container Exchange for having me. I really enjoyed it.
Oh, our pleasure. All right, bye everyone.